Welcome back, guys. This is the continuation of the course. I know that it has been a long time without updating, right? So today we are going to cover on two topics: the general terminology or the slang which is used in forex trading, and we are also going to cover on money management. So first of all, we have the tips. I think you have, I think most of you have heard people saying our stop loss is 10 pips, our stop loss is 50 pips. What does this mean as percentage in points? It just represents the distance moved by a certain day. It just represents the distance moved. Let's take for example when GBP USD, right? If we take our calculator here, for those who do not have this application, I recommend to download trading here, and you can use the website or the downloaded version, the desktop application. If I take my measurement to, right, if I take, let's say, from this point up to this high, this is how we count pips. There are 153 pips, right, to the up direction. So how do we count pips in forex trade? The number after 3 decimal places. So if we say 1, 2, 3, this fourth digit represents 1 pip, right? This fourth digit represents 1 pip. On pairs now like GBP JPY, USD JPY, AED JPY, it's now different, right? I'll just take you there. GBP JPY. How are we counting our pips? Our pips, we are counting them from here, right? 1, 2, 3, 4. The second digit after the decimal place is what is 1 pip when we are counting on GBP JPY, right? Same applies to USD JPY. Here is an example of how it shows on the M5. I just took a screenshot before so that we do not waste much time logging in M5 and here and there. Secondly, we are going to move to on spread. Spread now is the change, like the difference between the price, the buy price and the sell price, right? This is how brokers earn money. Like if you are trading a live account and you are not trading a funded account which does not put spread and puts commission, right? The small difference between the buy price and the sell price is those small cents is how the brokers make money, right? Whether you lose or you win in your trade, the broker will make money because of that spread, right? So how do we see this spread, right? If you look at your trade on TradingView, there is no spread, right? Because I'm not connected to my broker, I'm not connected to my live account. But if you look on your trading platform, right, there will be this gap. If you buy a certain market or a certain pair, right, predicting that it is going to go up, they'll buy it from this price, right? All the graph is here, they'll buy it from this price. The difference between this gap, you have already paid your broker. So when your TP is about to hit, this blue line is the one which is supposed to hit your TP, not this red one. vice versa. When you are also selling a market, right, they'll sell at the buy price, right? They won't sell at the sell price. They'll sell at the buy price. And when the market moves down, if this hits TP, your trade is not yet hit TP. The second one should hit TP. So you must consider very much when choosing your broker, because you don't want a broker which is a very wide spread, right? Especially if you're scalping, you might be looking for 5 pips, and when a broker has 2 pips spread, right, it won't be in your favor, right? It will be very disadvantageous for you. So looking at this example, we are seeing that this broker's sale price is 1.0803, whilst the buy price 1.0804. Removing the smaller digit, the 5th digit, taking in consideration of the 4th digit, the pip, it means that this broker has a 1 pip spread. So when you are now considering on choosing brokers, you must consider their spread. Right? You must consider their spread, because some brokers, they can even have 2 or 3 spread, or you can apply for a commission account. Right. Next, we have bid and ask price. Bid and ask price, this just represents selling and buying price. The bid price is where you get it when you buy a market, and the ask price is where you get it when you sell a market. So when you're buying, you pay the ask price. This is always a little higher as the spread from your broker added to the bid price. So it will be the bid price, right? When you are buying, you won't buy exactly at the ask price. When you are selling, you won't sell exactly at the bid price, because the broker adds spread on, and you will sell the market at an ask price. On volume, right? You have probably heard people saying they entered a position with 8 lot size, 12 lot size. In Forex, we use lot size. In other markets, they use contracts, right? For example, markets like oil markets, futures markets, they use contracts. But in Forex, we use lot size. What does lot size mean? Lot size generally means that 1,000 of the currency you are having, right? So many brokers offer mini lots, 100,000 of the currency you are having. So many brokers offer mini lots, right, and micro lots, right? Or the standard lot size, it is 100,000. As I was saying, there are mini lots and macro lots, so that you can not use one standard lot size. It is expensive for most people, right? You can even use 0.1 or 0.01 lot size. 0.01 will be representing 1,000 units, and 0.1 will be representing 10,000 units. The larger the lot size, right, the larger the money you can get, but the larger the lot size is also the larger the money you can. Now moving on, we move on to slippage. Alright, so on slippage, sometimes you enter a trade, right? There is high volatility, especially gold. This happens, right? You want 3,210, and let's say 3,210, they'll buy it 3,235. So that's it, right? The gram moving up and down with a high velocity. So if it is MT5, they'll tell you that the price you are about is not as the trade is going to execute. Are you still comfortable with executing, and you proceed? But if there are some platforms, like maybe your first is on platform for you to trade, they may not see it. You'll just see it on the trade that, oh, I was supposed to enter the price or and it did not execute. Or maybe if you put orders, sell on buy orders or the stock orders, you put a certain, but it won't execute at that price. Right? It will execute at a higher or at a lower price. This is called slip. Right? Usually caused by news, high volatility, and a lot of other factors. Right? And we also have swap. Swap now, it is caused by overnight trading or weekend holding. When you hold a trade, because you are trading a leveraged account, basically when you open a position, right, it is like you are borrowing money because you are trading on account, right? So the agreement between two governments, right, the deal between the two interest rates of two different currencies, the swap you are going to be what you are going to be charged when you hold your trade overnight, when you hold them over session, Tokyo session, New York session, right? So we also had the trade held up night, right? Friday morning, the swap was taken, right? This is what happened. Now going low, going short, you get binary option market and other markets. They say they are going to put or call. Basically, call means buy and put means sell. Same as in Forex, going long means buying a position. Going short means selling a position. Right. So the advantage of trading CFDs, right? In Forex trading, we trade CFDs. The advantage of trading is that you have an ability, right? You are not only waiting to buy at a low price and sell at your position at a high price. You can sell, right, at a high price, even though you don't currently have that asset, right? You can even sell it at a higher price and then buy it back at a lower price. And then bullish and right. This that generally means the direction of the market. When we have bulls, it means the market is going up. The market is going up. When we have bears, it means the market is going. So going to when we have
we're now on the support and resistance. One of the most widely used concept in my strategy, right? If you want to also follow my strategy, you have to let this sink. I don't know what you have to do, but make sure you know this concept. This is the first concept of my strategy, right? I use support and resistance. What does support mean? Support, it means the demand zone or a demand level. If something is in demand, it's a demand, people want to buy it, right? So how do we know that people want to buy this thing, right? It makes huge spikes, right? These little V's right here. If you see these little V's to the up direction, these little V's to the up direction, it shows that people have tried to sell it, but there's demand and resistance levels now. They are opposite of demands. They are supply zone. If something has huge supply, we see by the value of sellers, right? There are a lot of sellers, right? So this level, at first it was a support level, right? It was a support level, making these little spikes, these little V's going to the up. And then when price broke out, right, it came to a retest and then started going back down, making this support level also a resistance level. This is resistance right here. So I just used the same screenshot to show you that a support level can also be a resistance level. Now we are moving on to the one of the most important factors, right, in forex trading: money management, right? Now it does not matter how good your strategy is if you do not have money management, if you don't have a good trading money management, if you don't have management skills, you are going to be as broke as ever. You are going to always lose money, right? Right now I want to start with the basic concept of how a person can manage their capital, right, and stay long in the game and eventually be profitable in the game. First of all, a person should risk only the money they can afford to lose. For example, you all know that currently I have a 100,000 trading fund account, right? How much do I afford to lose so that I don't have emotions? Let's say personally I'm trading a $1,000 account, right? If I risk 500, right, I'm going to be checking the trade here and there. Each time I'm going to be checking on my screen. How did the trade go? How did the trade go? As long as you are not comfortable with sleeping while leaving your trade play on, it shows that you did not risk the money it shows that you did not risk the money you are affording to lose, right? We risk the money we afford to lose by first of all depositing the money you can afford to lose. You see someone, right? They get maybe per month they are earning 3,000, right? Total income minus the taxes and so forth, right? You see them putting 2,000 on the market. That's not realistic, that, right? You should at least put 10 to 20% of the income you are having, right? 300 out of the 3,000, that's fine. 600 out of the 3,000, that's fine. And you don't need to flip it. You can wait for it to accumulate. After 5 to 10 months, you see, you already have a $1,500 account. You already have a $3,000 account, right? You already have a $6,000 account, right? So deposit first of all the money you are willing to lose, right? The money you can afford to lose on the market, right? We do not want people to get into depression. Then secondly, risk the money you are affording to lose. You should always use a stop loss, right? Because that's the risk. Professional traders, they use mental stop loss. They don't put stop loss because they know when they are going to get out. But as a beginner, always use stop loss. Always use stop loss. And I'm going to say this again. Always use stop loss. Let me get on my trade which we got in this week, or my trades which we got into this week. Seeing this, it does not happen every time. It was just this week. I lose a lot of trades. There's a week I lost 9 trades consecutively on gold. On the same pair, 9 trades. So don't think that this is how I always trade, right? So this week I was entering in my 5 minutes time frame on entering positions. Looking at this, right? What am I looking at? What am I going to do on this position? I'm looking for a sell position, right? This red area, it represents my stop loss. If the trade doesn't go in my direction, right, I'm going to be taken out, right? I'm going to lose money, right? If you do not use stop loss, right, if maybe you were predicting that there's going to be a market reversal at this point, right, and you had taken a long position here, right, if you had taken a long or a buy position, if you do not have stop loss, the money is just going to keep on going in drawdown, until maybe you lose your account. And the worst comes to if you don't even know about lot size, because using a huge lot size, right, if it goes in drawdown a small bit of amount, you've already blown your account. That's it. If you use a big leverage is very good, right? It makes people be profitable, but leverage is like a double-edged sword, right? Just make a mistake and you lose your account. Leverage has made many people lose their accounts, right? So always use stop loss, right? Always use stop loss. I get in here, right? I risk maybe on my $1,000 account, I risk $50. That's 0.5%, and that's the normal risk people use in the financial markets. They do not use 10% per trade. No, it means that if you lose 10 consecutive times, it means you've already blown that account. Maximum should be 3. You should risk less than 3%. Always risk less than 3%. Always risk less than 3% depending on your account. If it's a $1,000 account, we understand when someone uses 3% risk, right? But if it is now something like a $10,000 account, $100,000 account, you should risk 1-2%. Why do you need to risk more? Because in the end of the day, you will be doing more than the one who has a $1,000 account, right? So this game, it also needs money. We don't have to lie each other, guys, and pat each other on the backs. That's the brutal truth. This is a game of money. You need money to make money. So always use stop loss. Always use stop loss. You minimize your risk that way. You avoid blowing accounts. If you hit your stop loss 20 times, 30 times, that's all well and good, because at least you still have money. If you don't have stop loss, that account would not be existing by that time. So always use stop loss. Then correctly calculating risk, what I was telling you. I'm going to be showing you how I calculate my risk. Personally, I use a calculator on my mobile app, right? You'll see it in my videos, right? In the strategy videos, right? But for those who are starting, they can use the Baby Pips website. It is easy to find and it is more convenient. Account currency, you choose your account currency and then you enter your balance. Take for example, I'm trading a $25,000 account, right? And then I only want to risk, let's say 1% per trade, right? And the stop loss of this trade, always use stop loss. So I'm calculating that if I get stopped out, right? I get stopped out at 40 pips is a lot. I usually take less than 30 pips on every pair. So let's say 29.2 here, right? Let's say you had put your stop loss at this level, right? Knowing that if it crosses this level, then you're all well and wrong. So stop loss at that level. So stop loss at that level, that is 29.2 pips. 29.2 pips. And my pay is GBP USD right here. Then you say calculate. They will tell you the lot size. You remember what I was telling you about lot size, right? They will tell you the lot size you're supposed to use. I'm supposed to use 0.85, right? Which means I'm using what? I'm using mini lots, right? I'll be using mini lots on this trade. Let's say it is this trade which I risked 15 pips, right? This means if this trade goes the other way around, if this trade does not play out, if I lose this trade, I only lose $250 after it has gone wrong in out of my direction within 29.2 pips. But let's say I was going to risk 15 pips like these previous two trades, right? And then I'll calculate my standard lot is what? 1.6 or 1.7. Let's just round it upwards and it will be 1.7. So when you are now entering a trade, what pips are your stop loss, right? It is seen here. If you put your position on your trading view, it will show you the number of pips. You don't need to count or put that measuring tool I was using, right? It will show you automatically that there are 15 pips here. And you just go to your Baby Pips calculator, put your stop loss pips, and then enter your position using the number of lot sizes they provided. Simple as that. And use of leverage. Use leverage wisely. If you are a person who flips accounts, I don't usually recommend that type of trading. I was once trading with that type of trading, right? I was good at it, but it is not consistent. I would turn maybe $8 to about 126, right? And then lose $50 in one day. Then I will have to withdraw 76 because I'll see that I'm about to lose the whole account. But if you're someone who depends on that type of trading, because long ago people depended on that type of trading, if you don't like funded accounts, because funded accounts, they have many rules. You use leverage, right? But also use it wisely, right? If you have $100 account, it's obvious you're going to use leverage. Your money does not buy anything on the financial markets, so it's obvious you're going to use leverage. When you're now using a $5,000 account, why do you have to use larger than $100 leverage, 1:100 leverage? As long as you are trading more than 5,000, and I'm going to repeat this, let me just say, as long as you are trading more than $1,000 account, right? Do not use a leverage which is more than 100. Do not use leverage which is more than 100, right? Those 2,000 leverage, unlimited leverage, they are for small accounts, the $100 account. Because a leverage, it won't limit you on taking trades, right? You end up taking maybe 9 positions at once because you still have the margin, right? But watch out for margin call. We are going to lose that account. Always use leverage wisely so that you can manage your capital. Following currency correlation. Some currencies have correlation. Let me show you this. It's not always, but I have seen that when gold starts to go up, right? GBP USD responds slowly, but it responds to what gold does. When gold started to go up, GBP USD also started to go up. GBP USD shifted its market structure. When is the 9 April, right? This was 4 a.m. And for gold, it shifted its market structure at 9 a.m. This is once in a while, but most of the times I see that the reaction that goes on GBP USD is caused by the action on JAL USD. So be careful if you are a person who trades 2 or more pairs. Be careful of the correlation. Some pairs have negative correlation while other pairs have positive correlation. Pairs with negative correlation, it means that when this pair is going up, this other pair will be going down, right? Pairs with positive correlation are the ones which I showed you, for example. JAL USD and GBP USD. It's not always, but there is a percentage in correlation, right? Correlations have percentages. Like, for example, AUD card, right, and USD card, they have a 90.1% correlation, right? When AUD card is going up, most probably USD card is going up by 90.1%, right? But AUD card and AUD JPY, they have a negative 62.3 correlation, which means it's more likely that when AUD card is going up, AUD JPY is going down. So this will also help you in your money management system, because personally I take 1, 2, or maybe 3 trades per day, right? When taking those trades, one, you have to look that on the trades I'm taking, is there no correlation? Because if you are losing money, you're going to lose a lot of money, right? While trading pairs that have correlation. Let's say I'm trading gold and GBP USD. Then I sell both of them once they are in an uptrend and they are going up. It means I'm going to lose a lot of money rather than getting into one pair, gold only, or maybe GBP USD only, and then buy, right? And it is not wise to buy gold and sell GBP USD when you know that they have a high positive correlation. It is not advised to do that. It also affects your money management system. So a person should have a certain pairs. Personally, I trade 7 pairs, but on those 7 pairs, 4 of them every morning, 3 or 4 only are on my watch list in the morning, and the ones I take my trades on are only 2 or 3. Every day I take 1 to 2 trades, right? At maximum 3. You should make sure, if you are a person who trades a lot of pairs, you should make sure that you check on the internet what is the correlation between these type of pairs that you are trading. So first and foremost, on a plan on your money management, right? You should have an acceptable risk per trade. Like I told you, I always risk 0.5 to 1% per trade, right? You should always also have a risk on your trade, right? That you place per trade, that this certain type of risk, I'm willing to lose it on a trade. Then secondly, you should have a maximum account drawdown, right? A maximum account drawdown will help you that, let's say for example, I told you about my losing streak. I lost gold 3 trades, 3 consecutive days. Why? Because I tell myself that I take 3 trades, right, per day. Why do I take 3 trades per day? Right? I know that if I lose 1.5 to 2% per day, I'm good on the markets. I'm going to leave the tables and I'll come again next day. So when I lose the first trade and I lose, let's say I'm risking 1%, I lose 1% on the first trade. I lose another 1% on the second trade. When I lose the third, I'm out, right? Because I do not want to lose more than 3% in one day, right? So you should always, this will make sure this will also help you to avoid emotional trading, right? Because when you are in a losing streak, you end up not using your strategy, you end up getting in emotions, revenge trading, and these many emotions affecting your mind. A minimum risk to reward ratio, right? This is very important, guys. This is very important. A person should have a minimum risk to reward ratio. They say if this trade does not have this risk to reward, I'm not getting in. As for me, if a trade does not have a 1 to 2 risk to reward, I'm not comfortable with taking the trade. Let's take for example, if I wanted to take a trade, let's say I wanted to take a trade for short position here, right? Short position here. And I wanted to target this low, right? I just want to target that low. And I see that, and I have my 25 pips stop loss. And I see that my risk to reward ratio is 1 to 4. I can see that I'm not comfortable with taking this trade, because if I lose 2 trades like this, I'm going to need more trades, right, to recover it. But if you have a risk to reward of 1s to 2, right, if you lose 1 trade, if you take the next trade and it's a win, you have covered it and you are also now in profit. If you lose 2 trades, right, and you have 1 win, you are still at break even. So this is why I only, minimum it should be 1 to 2. Usually I take 1 to 3 risk to reward, but the market is not so generous. It's not always giving those opportunities, right? So most of the trades, they are stopped out at trailing stop, and my trailing stop is usually maybe 2.41, sometimes 2.3, sometimes 2.5. So for example, this trade was at 2.5, this one was at 3, right? It hit stop loss, that's why it is still in 3. And you can see this trade, it hit our take profit, but it was a 1 to 3, right? So you should have a minimum. This one was a 1 to 2.4. Why? Because we aimed for 1 to 3, but the market gave us up to this psychological level. So you should have a minimum risk to reward. You should always tell yourself that no, if this trade does not have this risk to reward, I'm not going to take this trade, right? I'm not going to trade this trade. Now, to manage your money efficiently, create a certain rule for take profit and stop loss. Personally, I use the average true range. It is right here for stop loss and take profit. Right now, it is telling us that the volatility is 11 pips. This one, it just tells you the volume, the volatility of how the markets are moving at a certain point, right? If I put a stop loss of 6 pips, right, most probably, let's say I want to take a long position, most probably I'm going to be taken out and the graph will still go in my direction, right? That is if it was going to have a drawdown, but if it has led to no drawdown, you would still win. But we want a stop loss that will allow the price for some breathing room, and then it will still go in your direction, right? So if I take a trade with 6 pips and my ATR is telling me that 11 pips, that is not sensible, right? So how I use my stop loss, right? is that I take my ATR and say +5, or take my engulfing candle. That is if I took the trade because I saw the engulfing candle. I say engulfing candle +5 pips, or ATR +5 pips. Let's say right now our ATR is saying 11, right? And there's an engulfing candle which is saying 10 pips. I consider the ATR and not the engulfing candle. But let's say the engulfing candle is saying 11 pips or 12 pips, and my ATR is saying 11 pips. I still use the engulfing candle and say plus what? +5 pips, because with that volatility, if price goes down more than the engulfing candle now, it shows that there's still ranging market, right? Or the price is, maybe I was wrong, right? So you should have rules, right? And backtest them and see if they are consistent. If they are taking you out and the graph continues to go in your direction, it means you have a tight stop loss. You should adjust your stop loss and make it bigger, right? Depending on the market conditions. So a person should create take profit rules and stop loss rules. My take profit rule is that the size of the stop loss I'm seeing on the graph, my take profit should be that risk multiplied by 2,5. That risk multiplied by 2 multiplied by 3, right? Those are the rules. For psychology, guys, since I'm not a psychology expert in trading psychology expert, I'm just going to share with you a few tips on how you can try to control your emotions. Everyone has emotions. I also have emotions in trading, right? Everyone has emotions, right? But you need to try and control them, right? We are all humans. We are not machines or robots, right? So first of all, you mustn't take too much risk on one trade. As I always told you, each trade must have a certain stop loss you are willing to risk, right? Each trade must, there is no trade which is said, this is an exception, I'm going to risk 5%, or this is an exception, I'm going to risk 10%. That trade you're saying is an exception. It might just start going in your it might just start going into drawdown, and you see that you have lost all the money you have made for the day, and you are losing even more. Or maybe you are losing even the money you made for the whole of last week, because personally per week I make maybe 3 to 6%. At max 9%, that was my record, right? But I make 3 to 6% on average, right, per week. So if I risk 10% in one trade, I'll lose my bowels, right? I might throw up, because we are now going back to zero. We have lost half of the month, because a month has only four weeks, right? We have lost half of the month in only one setup. So don't risk too much on one trade, because that is going to affect you emotionally. It is going to affect you so much emotionally. And don't chase your losses. As I told you, I lost 3 trades, right, on Tuesday. It was Monday, I was up 3%, right, with just one day, which is nearly my weekly average, right? And then Tuesday, I lost 3 trades on gold. I was now down 1.5. Wednesday, I lost the other 3. I gave back to the market what I made the whole of Monday on Tuesday and Wednesday. And then Thursday, I lost the other 3. What was happening through my mind? I was so devastated. I was so broken. And the market was ranging, right? There was no clear direction, right? So I was just losing to that certain pair code, right? I was devastated, but what made me not lose my account now, right? My account was kept safe because I knew that if I take two trades per day, right? If I lose all 2, I take the final one. That if it is a win, I can recover the losses, right? Since my risk to reward is 1:3, I'll make a little more profit than the loss. If I have a loss, I will know that I have the I ended the day with a 1.5% loss, right? So that is what I set up, right? When I lose trades, I take one last one, right? The third one. If I take 3, I do not take any more, even though there are opportunities on the market. I do not take more, right? I wait for the next day, right? So that I do not stay on the market trying to revenge trade, trying to take back my profits, or trying to boost my account, right? Do not overtrade and make too many trades. There is something called the trading trifecta, guys. Overtrading, people may think that it is how you earn more money, but overtrading is how you lose more money. Why? Because the more you trade, right, the more your losses also compile. Why? The trading trifecta rule, it says that there is a balance between the risk to reward, the win rate, and the trade frequency. If you take too many trades, it means your trade frequency is high. If your trade frequency is high, maybe you have a higher risk to reward. 1:2 is a high risk to reward, right? It means that your trade frequency is going to be low. Or if you have too many trades, it means your win rate is going to be low. But or if you have too many trades, right, and a high win rate, it means your risk to reward is going to be maybe 0.2, which makes no sense, right? And you are at the end of the day at break even or even less, right? You are not making progress, right? And another rule, don't let the last trade stop you from making your next. Just imagine having 9 consecutive losses in one pay, right? How do you feel? Let's not say 9, 5 consecutive losses in one pay, 5 or 6. Going back to that chair and start to execute is very painful, guys. Sometimes you start feeling afraid, you start being scared to even press the buy or sell button because you don't know what will happen in the market. But you should just continue with the process, because most of the people who don't go back is because they did not backtest. If you backtest, you know that this losing streak is happening, it's just a losing streak. I'm going to win, right, in the long run. You should not look at the results now. You should look at the results in a month's time, right? Like at the end of the month, am I profitable? That's what you should look at. You should not look in that hour or in that day or even in that week. There are some weeks a person can be minus 2%, minus negative 3%, but they will recover their losses at the end of the month, and then they are up, right, a certain percentage, right? So never ever let your last trade stop you from taking the next one, right? Don't be afraid of stop losses. Stop losses are very good in trading. You have stopped your account from blowing. You have stopped a loss, right? You have stopped execution from keeping your money going more into negative. So a stop loss is good. As long as it is according to plan, you must be happy. I stopped a trade. I stopped it at a stop loss, right? And then always cut your losses short, right? Always cut your losses short. I wouldn't say you should use a mental stop. Always put a stop loss and do not adjust stop loss. That's all. You only adjust stop loss when your trade is now in positive and you want to trail your stop so that when it goes down, it might hit break even. Let's say it opposes your direction before going to TP, or it might hit a positive positive other factor. Let's say, for example, your trade is already floating in 1:3.5. You can put your stop loss in 1:2.5, right? So that when it reverses, instead of losing all you had gained, at least you only lose maybe this 1% and still gain another 2.5. That's the only moment you move your stop loss. Otherwise, never move your stop loss. Never increase your stop loss. We said we risk 1% per trade. Never ever increase and say, no, this trade is going in drawdown. I want to increase it a bit so that it can have a breathing room. The breathing room you calculated before does not change because they are now in trade. I told you, you plan what you're going to do about the trade before you enter the trade, not to plan what you want to do with the trade when you're now in the trade. So with that being said, guys, this is how you manage your account, and those were the general terminology we are going to be using for this course and my strategy. So with that being said, guys, see you next time. Peace out.